For decades, McDonald's was the most popular fast food chain in America, a place where families and children could enjoy a meal at affordable prices. But those days are long gone. Now, the soaring cost of several menu items is making the company lose millions of customers and billions in sales every year, resulting in worrying cash flow problems that are accelerating its collapse in the very industry it helped to create. In this video, we explore some of the reasons why the world's largest burger flipper is losing momentum and falling apart in the US market as the brand continues to lose its essence. But before moving on, we kindly ask you to support our work with a thumbs up, and don't forget to subscribe to our channel so you don't miss what's coming next. The company that introduced America to fast food and stood as an icon in the industry for decades is now dying before our eyes. After 2 years of facing persistent price increases following the pandemic, McDonald's customers are now cutting back their visits to the chain or choosing cheaper fast food restaurants as they fight food inflation. This year, conditions are rapidly deteriorating for the brand, with its stock hitting a 52-week low after the company reported a sizable drop in foot traffic. May was yet another month where a wave of customer defections hit several McDonald's restaurants across the U.S. Since the third quarter of 2022, the company has been posting disappointing sales growth and declining sales, which is raising alarm for investors and for competitors. New data shows that these are lean times for the world's biggest fast food chain. In 9 of the past 10 months, the burger flipper reported losing customers in the United States, and a new analysis reveals that has everything to do with its new pricing strategy. In April, McDonald's announced price increases on a number of menu items for the second time in a single quarter. The company noted the decision came amid rising commodity prices and labor costs. The last price hike was seen on February 15th when it raised the cost of 5 combos by $1. But indicators show that consumers are getting fed up with high costs at McDonald's restaurants. According to data released by RMS, 34% of customers are ordering less expensive menu items, while 30% are choosing less expensive restaurants. 40% of consumers said they believe they're getting less value from McDonald's meals than they were just a month ago, and 82% say it's because of higher prices. In the first quarter of 2023, the company reported an average price increase of about 10% in its U.S. locations when compared to the same period of the prior year. Although executives said that higher menu prices are helping the company to boost earnings and revenue, analysts argue this is also shrinking the chain's customer base, which will ultimately hurt its bottom line. Recently, a TikToker went viral for exposing some incredibly high McDonald's prices. In the video, which has over 300,000 views at this point, the user zooms in on the McDonald's menu at a Connecticut location while commenting on the combo meal's crazy prices. A Big Mac combo, for example, was listed for $16.89, while a McCrispy chicken sandwich combo was listed for $16.69. Other variations of the McCrispy line were priced even higher, such as the Spicy Deluxe McCrispy, which was listed for a whopping $17.89. By comparison, just back in 2019, a Big Mac cost $5.75. Now, it costs roughly $7. If one were to add the hamburger to a large meal 3 years ago, it would have cost $10.55. But now, they have to pay almost $5 more for the same combo. And it doesn't stop there. In 2019, a Filet-O-Fish sandwich was notably $5, but is now $6.80, and a box of 20 McNuggets used to be $12.40, but is now priced at $13.30. Other surprising menu increases include a chicken snack wrap, which increased price from $2.50 to $4.15, and a large Coke, which was $3.35 in 2019 and now costs $4.55. Have McDonald's Filet-O-Fish always been this small? I don't remember it being mini kid size like this, one customer commented on the company's Facebook. Many others also pointed out that they felt their favorite McDonald's foods were shrinking. Another shopper added, "We had Big Macs last week. Not only have the buns shrunk, but the meat patties were so thin we could literally see through them. It was as if they've sliced them in half." Someone else commented, "Just like the Quarter Pounder got its name as it was a quarter pound of beef, it's barely that now." And another replied, "Inflated price, deflated goods." Even the chain's chief executive is admitting that the higher prices are making customers buy fewer products. We are seeing, in some places, resistance to pricing, more resistance than we saw at the outset. McDonald's CEO Chris Kempczynski warned during a recent earnings call. The company said it's seeing pressure on its key units per transaction measure. In other words, the typical cost-conscious McDonald's customer is balking at higher menu prices. As a result, they may be buying a hamburger, but not getting a side of fries. Or those with a little more cash in their pockets could be buying more premium McDonald's dinner items, but leaving out a drink or dessert. Earlier this year, the fast food giant reported a $100 million drop in consolidated revenue over the past 12 months. During the same span, earnings dropped by almost $200 million, while its net income for the year decreased to $6.1 billion from $7.5 billion the previous year. All that is thanks to falling guest counts all over the country. This scary trend has been worsening over the years. Since 2014, McDonald's has been experiencing a steady decline in consumer traffic. Even though same-store sales have risen over the past decade, higher average checks drove these numbers, not customer visits. New items, fresh beef, price promotions, new technology, delivery, and newly designed stores have not helped the chain to expand its customer base. According to its 2022 fourth quarter report, the brand's underlying problem of slower foot traffic has been seriously aggravated due to rising inflation and the surging cost of basic expenses. How many millions of lost customers will it take before McDonald's really focuses on reversing this risky trend? Asks Forbes contributor Larry Light. He predicts that for the company to increase revenues, relying on average checks on a shrinking customer base will require the average customer to spend $20 per transaction. In 2017, one Forbes article revealed that McDonald's was down by 500 million customers worldwide. Now that was 6 years ago, and the trend of lost customer traffic continues, Light notes. McDonald's is compensating for the transaction decline by focusing on increasing average menu prices to boost revenues, but while customer checks go up, the frequency goes down. Increasing average check is not the solution to declining frequency. Increasing average check will accelerate the decline in customer count, the analyst argues. This troubling pricing strategy is accelerating the brand's downfall. During a call with investors, the CFO highlighted that McDonald's cannot survive with declining customer counts. Corporate knows that it's impossible to maintain a chain that operated 38,000 stores across the globe on a shrinking customer base. Still, nothing has been done to prevent this from happening. Higher check prices can also lull management into complacency, and although increased menu prices do increase same-store sales comparisons, price hikes mask a problem that even McDonald's executives know can become toxic. Price promotional deals create deal loyalty, not real loyalty, the Forbes analyst explains. What is more troubling about declining customer frequency is that there do not appear to be any solutions coming from corporate. Hoping for a turnaround is not a strategy, he stresses. In fact, as reported by Business Insider, many McDonald's customers are turned off by some of the corporate initiatives, such as recent marketing campaigns, confusing tech at drive-through menus, or kiosks that are credit card only. Its expensive Experience of the Future plan has failed and did not attract any new groups of customers to its stores. Wall Street is getting worried about this situation. Last October, a financial analyst released an article pointing to McDonald's two key problems. One, persistent decline in guest counts, and two, unsustainability of the increased price strategy. The analyst wrote that pushing up prices to increase profits in the short term will only contribute to the company's long-term demise. He emphasized that relying on increasing average checks with a declining customer base is dangerous. It hides the fact that customers are leaving McDonald's. Making customers spend more to consume fewer items comes with serious consequences. At some point, a small number of customers are going to have to run up a very high check and will need to visit McDonald's every day just to keep the company afloat, according to Forbes. To make things worse, expensive items are expected to continue contributing to lower transactions, as customers perceive that the brand is no longer affordable and it is losing its essence. The truth is that over the past few years, the fast food giant has been trying to change its brand personality to a new, hipper, technophile customer who can afford higher prices. But this means it's no longer the warm, casual, affordable, family-friendly chain that's gained the sympathy of the average American. Its new strategy is to attract a higher income, modern, progressive customer. However, this desire to ditch the current customer base is not working, and the brand still needs a lot more of these customers to stem the profoundly leaky bucket Light outlined. It is clear that is not the case today, despite all the digitalization of the brand. Technology can be helpful, but without a focus on better quality food and service, the McDonald's brand experience will suffer, he added. McDonald's must stop the hemorrhaging of its customer base. Using higher prices to deliver top-line sales is the wrong medicine to cure this brand disease, the Forbes contributor emphasized. To illustrate the hole in its strategy, let's assume that the current estimated average check is around $6.50. And let's consider that the average customer frequency is around 3.1 times per month. According to Larry's calculations, if instead of increasing average prices to cover for declining customer visits, McDonald's committed to holding the average check at $6.50 while persuading the average customer to frequent McDonald's just one more time every 4 months, this would result in an 8% increase in in-store sales. This is 4 times higher than the current comp sales currently reported. This result is only achieved by increasing customer loyalty. A small increase in frequency can make a huge difference to the company's financial health. Seeking Alpha's financial commentators note that McDonald's current value is built on increased debt to support increased dividends and share buybacks, instead of packed restaurants delivering high-quality, delicious food served quickly to its customers. Considering its enormous operations worldwide and the conditions that led the company to become a huge success, it is very odd to see that instead of investing in keeping and growing its base of customers who can afford to regularly frequent its restaurants, the brand is focusing on gaining a public that already has hundreds of options of higher-priced burger chains out there. The bottom line should be more customers, more often, more loyal. yielding more sales and therefore more profit. Nothing in the recent earnings call indicates that the corporate strategy has changed. Continuing to do the same thing and hoping for different results will not work. Hope is not a strategy. Relying on increasing average checks from a base of fewer, less frequent, less loyal customers is a formula for failure, the analyst warns. In an industry that's getting more and more competitive with each passing year, being one of the largest and oldest chains in the market is not a synonym for success and growth anymore. Businesses have to adapt constantly and, more importantly, value the customers that they already have. The fall of McDonald's is a self-inflicted crisis that will spark major repercussions for the company in the near future. And that means America's most iconic fast food chain is at serious risk of collapsing all around us. And its downfall will be very painful to watch. What are your thoughts on this? We look forward to reading your comments, and thank you for watching.